Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, March 12th. American and Canadian officials have just spent the last few hours imposing tariffs on each other, only to roll them back, adding to the absurdity of the tariff situation. The problem is that this tariff charade has real-time consequences, and that's obviously weighing on investor sentiment and pressuring the market valuations. Now today, all eyes are on the US CPI data update. A softish print from the US today that would be in line with the market expectations could eventually help keep the bearish sentiment of the market in check, but will hardly bring appetite back to the table. The headlines change so fast, I've never seen this before. Earlier this week, Ontario in Canada decided to snap 25% tariffs on electricity that it sells to the US. And yesterday, Donald Trump said that he would then increase his tariffs on Canadian steel and aluminum imports to 50% starting from today. Then Ontario just came back and decided to roll back its 25% tariffs, and Trump let go of his 50% tariff threat. So this morning, there are no tariffs due to go live if I understand well. The retaliatory tariffs, on the other hand, are still scheduled to go live from April on. But given that the tariffs go on and off very quickly, it's difficult to forecast what is next, obviously. The only thing I know is that the impact on market sentiment of this tariff situation is quite big, and it just actually goes beyond just sentiment. Because look, American manufacturers are already paying significantly more for aluminum, steel, and copper compared to their overseas rivals, as they are right now rushing to accumulate inventories before tariffs go live, which could happen overnight. So it's very fast, is very unnerving. So this growing gap between the raw material prices paid by Americans versus their European and Asian peers is obviously making the American manufacturers less cost efficient compared to their rivals. And it weighs on business confidence as well, and it also fuels inflation and inflation expectations even before the tariffs are imposed and even before we have the clarity that they will or not be imposed. And the expectation for squeezed profit margins due to the actually rising raw material prices is obviously weighing on market valuations. In this context, the S&P 500, for example, gap opened yesterday to the downside, fell to 55.28 level as the lowest level since September, and the index recovered slightly into the close, but closed 0.76% lower yesterday's trading session. Nasdaq also extended its own losses, though the speed of the sell-off in Nasdaq slowed compared to the day before. Then the Dow Jones Industrial Index lost more than its major peers at yesterday's trading session, while the Russell 2000 Index closed yesterday's trading session with a small rebound of around 0.22%. Now, the market volatility is rising as visibility becomes cloudier by the day. Any market rebound may not be viable unless there is a form of stability and reason at the White House, but that doesn't seem to be on the menu du jour. So the higher volatility will likely convince an increasing number of investors to step out of their bullish positions, and given the high positioning for the US assets that have been accumulating over the past few years, well, we could see the market sell-off extend in the US assets. Now, today, the US will be updating its CPI numbers, and the data is important. It is important because this tariff situation will probably start to show in producer prices first and will impact consumer prices in the continuation as such. Today's CPI data update from the US is expected to show a slight easing. Yes, easing for both headline and core inflation numbers in February and for both monthly and yearly figures. Because after all, the energy prices, well, they have been tumbling since the start of this year, and that should have an easing effect on inflation. And that could also counter the rise that we see in food prices, especially the egg crisis in the US. But whether this disinflation situation could continue is yet to be seen. On Thursday, the PPI number, so the producer price index, will be closely watched by investors. For now, the expectation for that is also a slight easing in the February figures, and that's also partly thanks to the cheaper energy prices since the start of this year. So a set of inflation numbers in line with the market expectations, or ideally softer than expected by analysts, will not guarantee that inflation will remain under control in the US due to tariffs, but it could actually give a bigger margin for the Federal Reserve to act if necessary. A set of inflation numbers above expectations, however, God forbid, would just be the sour cherry on top of an already staling cake. The higher the inflation and the inflation expectations, the less likely for the Federal Reserve to cut its interest rates unless the market sell-off in the US gets ugly to an extent to threaten the financial stability, which could then give the Federal Reserve, which has a double mandate, remember, of price and financial stability, well, it would give the Fed a reason to maybe support the US economy, and that despite the rising inflation and rising inflation expectations due to tariffs, on the thinking that the tariff-led inflation would be a one-off rise if, of course, they one day go live and stay there. So the US dollar continues to lose value across the board on this expectation of a sharp economic slowdown in the US economy that could even lead to a recession of the US economy later this year. Activity on Fed funds futures, on the other hand, tells that the first rate cut from the Federal Reserve would be for June and not before, but again, an acceleration of the sell-off in the US markets could help pulling that timeline a bit earlier to May, for example. For now, the probability of a potential May interest rate cut from the Fed is given just around 40% chance. So I will be watching that metric and how that metric evolves in the next few days into the next Fed meeting and after the CPI data. Now, across the Atlantic Ocean here in Europe, yesterday saw the sell-off in the Stoxx 600 index accelerate. The initial sugar high that we saw in the European stocks due to this massive spending plans from the European countries led by Germany is now replaced by negotiations, obviously, among different political parties, as every party is trying to get a bigger part of the cake for themselves because the spending is going to be big. But in fine, the US threat is real, obviously. Donald Trump is sitting in the White House for just less than 2 months, only less than 2 months, and there is need for funds to survive to next 4 years if things continue at this pace. So whether you are green or blue or red on the political spectrum, it doesn't really matter. The security comes first. Therefore, I continue to believe that the European stocks will continue to outperform their US peers on this converging growth expectations in favor of the European economies. And the convergence trade between the S&P 500 and the Stoxx 600 index will then remain in play. Inflation from the government spending from the European governments, on the other hand, could actually remain limited to specific sectors, according to Glenn from NFG Partners. So you will hear more about that conversation in our next quarterly outlook. Stay tuned. But if that's the case, while consumer inflation in Europe and across the Eurozone countries could eventually remain under control, the stronger euro is also good news for inflation. Remember, as the stronger the euro, the lesser the inflationary pressures for the European consumers, because the things that we buy outside are cheaper. So a situation where inflation remains under control would then allow the European Central Bank to keep its interest rates at quite a sweet spot for the economy, and the latter could boost growth across Europe. That's the thinking. And yeah, we need a silver lining lining in this agitated, market situation, right? So here is your silver lining. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the inflation data, and until then, good day trading.